Okay, welcome everybody. I'm Gordon Dawson. I am the founder and CEO of School Notices. I'd very much like to welcome all the sixth form attendees from Downhouse, Marlborough College and Winchester College this evening. I'd also like to welcome our three panelists from Aberdeen Standard Capital. That's Matthew Grange, Elizabeth Pinder and Jordan Byman. This is the first of our three financial awareness webinars which we're holding. The second being on March the 3rd in a month's time, and then the third being a week later, March the 10th. For everyone with 100% attendance, there will be a certificate, which will be very useful on your CV. And there's also a great opportunity of internships at Aberdeen Standard. There will be a Q&A at the end of the slideshow. We're hoping to have about 45 minutes of slides and then a 15-minute Q&A. So please, really want to encourage you to get involved with sending us questions. We'll hold on to those and then we'll answer them all at the end. There will also be various polls throughout the slideshow. Again, please get involved. Just a really interesting kind of fun engagement for you all as we go through the slides. Lastly, just want to apologize. We'd much rather be doing this face-to-face, but that's not possible now. So this is via Zoom. Won't be 100% perfect, so I apologize for any scratchiness of performance, but we're going to do our best. So without further ado, I'm going to hand you now over to Matthew, who will kick off the slideshow. I hope you all enjoy it. And yeah, over to you, Matthew.
As Gordon explained, there's going to be 3 sessions, but we totally understand that a lot of viewers have got different types of backgrounds. Some of you might have studied some economics or some finance and others haven't. So we've deliberately designed this over 3 sessions so that everybody can get something of interest from this. Over this evening, we're going to cover topics like why do you need to invest, who invests, different risk levels that might be appropriate for you. And we're also going to be looking at sort of a day in the life of a portfolio manager as well. So maybe if you're thinking about a career or it might be just a general interest, we'll cover that as well. Firstly, a little bit about ourselves. So Aberdeen Standard Capital, for those of you who have not heard of us, we are the private client business of Aberdeen Standard Investments. Aberdeen Standard Investments are sort of the largest fund managers, one of the largest fund managers in the UK. We've got over 1,000 investment professionals and like 6,000 people in total. But we're a sort of truly global business with like 40 offices around the world. Managing over 500 billion. I think what that gives us is like really good, interesting insight to the global affairs, and we'll pick up on that as we go along. In our business, on our side of this business, we're managing money for private individuals, trusts and corporates, and also charities. We've got a very strong charities team, sort of managing over £700 million there. We really believe passionately in investing responsibly. So we've dedicated the second session to that, and hopefully we'll all find that of interest. So I'm joined this evening by Elizabeth Pinder and Jordan Byman. Jordan is based in London with myself. Elizabeth is in the Leeds office, and I'm in London, and I head up the international team, and I'll cover a bit more about that a bit later. So welcome to everyone. Thank you for joining, and I'm going to hand over to Elizabeth. And don't forget about the Q&As. It'll be really good to get some good questions from you. So over to Elizabeth, please. Okay,
if you'd like to go to the next slide, please. And the next one, thank you. Okay, so a good question to kickstart things is really, why do we invest? Clients have a very wide range of objectives for their capital, from saving up for a new car and our first home to family holidays or upgrading our car in later life. A big part of investing is saving for retirement. The state retirement age is only heading one way, and clients need to appreciate the need to have capital to support them in later life. Residential care is extremely expensive and there is little government help available. So it's a key consideration for our older clients. And I think the key message here is really to highlight that people invest for lots of different reasons and over different time horizons as well. And these reasons do change as we grow older. So if you think of your own position, what are your saving objectives and what do you need to plan for in the future? If you'd like to go to the next slide, please. This is just a fancy graph to basically highlight that we spend our younger years growing our wealth. and generally investing for capital growth. We can take a little bit more risk as we have more time on our side. And as we grow older, all the money we've saved, we then depend upon for an income, which depreciates our overall wealth. Some people deploy strategies to pass on this wealth, whereas others enjoy spending it. The next slide, please. So inflation. You will hear this word in the news all the time, but what actually is inflation? In its simplest term, it is the rise in prices. So we measure this by creating a basket of everyday goods like petrol and electricity, and we track these price changes every month. So inflation is a key risk for how much money we make on our investments. If prices are going up, our money can buy us less. So if you think about it in a really simple way, if your parents gave you £1,000 to buy a MacBook today, but the price rose to £1,100, you can no longer afford this MacBook with the £1,000 they gave you. So the graph on the right gives us different examples. So if we like to consider the 3% red line, which sounds high at the moment, but if you think about average inflation's been about 2.8% over 15 years, the £1,000 today would be worth £500 in 20 years if you left it under your mattress. This really highlights the power that inflation has on our money. So this is where we're going to kickstart the first poll. So please can we have the questions? The majority of people went for the 1 to 2% option for question 1. Well, actually, in fact, in December 2020, CPI, which is Consumer Price Index, was actually 0.6%. So this is pretty low, and it's well below the UK's target of 2%. If you think about the current environment we're in, there's been a cap on electricity and gas prices. The shops have had huge sales, and they've actually been shut. So this has really pushed prices down, and we're experiencing a very low period inflation. Now, if we look at the second question, most people have gone 15 to 20%, which is very high. It's nearly right, but the actual correct answer is D. So in 1975, inflation was actually 24.2%, which is very hard to imagine compared to the current inflation rate. This was down to the oil price tripling in the 70s. And we also had inflation due to rising wages. Back then, the unions had a lot of power, and they bargained up the price of wages to keep up with the cost of living. So we know inflation is bad for our investments, but what do we actually do with the cash under our mattress? Normally, we have the issue where bank rates are way below inflation, which is shown on the slide. But currently, we're seeing interest rates at record lows. The Bank of England have set rates at 0.1%, and with inflation running at 0.6%, there's not really that much of a difference, but it still stands that banks are basically not offering you a return on your cash. So TSB have recently slashed my interest rate from 0.5% to 0%, and Marcus, which is Goldman Sachs' online savings offer account, were one of the best on the market at 1.5%, and even they're offering only 0.7% now. So basically not making any money on cash, especially when you add in the effects of inflation. So if you'd like to go to the next slide, please. Okay, so these low returns are pushing people to invest in the market to get a return on their money. These two graphs really highlight the importance of compounding. The longer you have your money in the market, the more it grows. So the graph on the right, if you start saving at 25 rather than 35, your pot is more than double the size after 40 years. So this is assuming 8% growth. So starting at 25 would grow the portfolio to 1.3 million compared to 600,000 if you start at 35. So that 10 years difference is a staggering difference. Okay, and the next slide, please. Now I'm going to discuss risk and return. So we've touched on why we need to invest, but with investing your money comes risk. You cannot guarantee your money is going to go up every year. And this simple chart shows that risk and return are correlated. So as I was just saying earlier, cash is returning 0.1%. So on £100, you're getting £1 a year. This is a very low expected return, but there's virtually no risk with holding cash. Now, if we look at investing in the share of a company, we might expect the share price in Morrison's, for example, to rise from £10 to £15 in 1 year. Hence, the expected return is much higher. However, this isn't guaranteed and lots of factors come into play. So what if the company goes bust or a flood wipes out its largest factory? This is an extreme example, but it's an example that your share could fall from £10 to £1. Hence, we have a higher risk. Next slide, please. Now we're looking at how the business cycle and the economic cycle are directly linked. These prices in shares move, the movement in share prices is directly linked to the business cycle. So the black line shows the business cycle and how a country's gross domestic product changes, or in simple terms, how much money that country can make. In expansion, things are looking good, businesses are doing well, and factories are busy. Lots of people are wanting to buy MacBooks, for example, but the factories can only produce so many. So this demand pushes up prices and we reach a peak. The economy starts to overheat and events lead to a recessionary period. And this is where we experience 2 or more quarters of falling GDP. So the most recent recession is obviously from coronavirus. Huge amounts of the economy have been closed, meaning companies have made less money. If we think about it, there's been less people in city centres, spending cash at restaurant, bars, sandwich shops, and this has directly resulted in job losses. So less people earning money means less tax revenues and less for the government, and basically just less money to go around. So the stock market is directly linked to this, as shown in green. As companies are doing well, their share prices rise, and we call this a bull market. And as we go into recession, everyone is a little bit poorer and share prices tend to fall, and we call this a bear market. Next slide, please. So this slide basically discusses the fact that at different points in the cycle, different sectors of companies do well, which is highlighted in the table. I'm not going to read them all out word for word, but it's worth thinking that as we approach the end of the cycle, we start to position portfolios for a change in how consumers start to act, which leads nicely on to the next poll question, please, Gordon. Okay, so the first question was a bit of a trick question, and the majority of people went with the answer we thought we would. So yes, if you selected pharmaceutical companies, although this would benefit them, it would only be a marginal benefit relative to the more cyclical industries like mining and general retail. So it wouldn't be bad for supermarkets, but it wouldn't be as good for general retail, because we're seeing like a period of pent-up demand. People are going back out, spending money in the shops. Number 2, tobacco companies. So yes, this is right. You know, people don't stop smoking in a recession, but we've got to consider, would all clients be happy with tobacco investment? This is a good example of how we manage money for charities. So the trustees have a dilemma of wanting to protect clients' money, but also potentially excluding sectors of the market on ethical grounds. So this is something we'll cover in our next session. But also, if you selected luxury goods companies like Hermes, these also have done very well in the pandemic. Typically, very wealthy people protect their capital in downturns, and demand for Birkin handbags has remained constant regardless of the economy. So we're going to look into like how these different asset classes have performed in different environments in a later session. But for now, I'll hand over to Jordan, who's going to discuss who invests in the market.
Thanks, Elizabeth, and good evening, everyone. Hopefully you can hear me okay. So I'm going to start off by talking about who invests in the market. So a lot of people don't actually realise that you could already be exposed to the investment market. And this slide really just highlights the sheer amount that's invested. It's focused on the UK, and these stats were taken from 2015. So a lot of these figures would be even greater today. There are clearly many different types of investors interacting with each other within investment markets. So the yellow circle on the bottom left, this highlights pension schemes. Once you enter the workforce and start contributing to a pension, that pension will likely be invested for you. On the bottom right, we've got the light blue circle. So this is private investors. A lot of our clients will fall into this bucket. And you indeed might already have a junior ISA already set up and fall into that category. Even insurance companies in the purple circle invest. And when you've taken out car insurance, for example, in order to match their liabilities, they will invest in the market. I also just wanted to highlight the green circle on the top left, and I did see a question come through earlier. This is obviously the retail investor, and this has been in the news a lot. These are individuals purchasing investment products or stocks and shares directly. And obviously they're going to have an increasing impact in markets going forward. But obviously many headlines at the moment with US retail investors using trading companies such as Robinhood to invest directly in the market. And then the silver circle at the bottom shows non-profit, which is also an area that invests. We ourselves, I know Lizzie and Matthew have mentioned that Aberdeen Standard Capital have a growing charity team. We look after approximately 750 million of assets on behalf of charities. And of course, schools and universities are also big investors. So I was going to have a quick poll now, if we can bring that up. So the majority, 48%. Yeah, so you got it right. So actually, at the end of 2019, the Harvard University Endowment Fund actually had $40.9 billion invested. So a real staggering amount there. It just shows the power of non-profit in the market as well. So big players. So if we go on to the next slide, please, that'd be great. Brilliant. So Aberdeen Standard Capital, we're discretionary fund managers. It very simply means that we manage investment portfolios on behalf of our clients, whether they be private clients, charities, or trusts, both in the UK and internationally. We also work with financial advisors who may outsource the investment decisions of their clients' portfolios to us. So the key word here is, to describe what we do, is discretionary. So it basically means that any investment decisions are at our discretion. So essentially our clients are entrusting us to make those decisions on their behalf based upon our understanding of their goals. And so to achieve this, we have to have available a broad and wide-ranging suite of investment solutions that are appropriate for varying risk levels and investment objectives in order to provide our clients with both choice and flexibility. Secondly, and most importantly, we need to really understand our clients' goals and their needs and aspirations in order to provide them with an investment solution that's suitable for them. So on the bottom right-hand side, we've got a diagram here showing an investment journey. And what we're really trying to show here is the different stages that people have throughout their lives. We can broadly split it into two halves, so the saving phase and the spending phase. So starting in the top left quadrant, you have accumulation, which you can think of as trying to save money every month, investing in your pensions, really accumulating money to support later life. This may have already begun for some of you, but it definitely will begin once you enter the workforce and start contributing to your pension every month. And just going back to Elizabeth's point, starting early can really make a difference. And thinking about compounding returns, investing at the age of 25 versus 35, for example, it really is astonishing the difference that can have on the final result. This then moves into early retirement, where the goal starts to shift and you start to think about fulfilling future retirement goals and what will be required to meet these goals. So this could be anything from traveling, purchasing a holiday home, but most likely supporting spending in retirement. So this next phase then enters into the spending phase. So moving from saving to spending, it's all about sustaining income, and it's really related to supporting your lifestyle in retirement. I'm sure it will seem like a long way away for many of you, but after you leave the workforce and stop receiving that monthly paycheck, it's at this phase that many retirees will call upon their pensions or other investments to really support their living expenses. And then finally, we have the later life planning. So this is a bit morbid, but this is part of the journey that's essential. It's really where the clients start thinking about the balance between looking at what you want to leave for future inheritance or charitable donations, for example, while still supporting your ongoing living requirements. So as you can see, there's many different stages. And it's really about understanding where a client might fit in one of these journeys. And whilst we can give some examples here of goals such as supporting grandchildren onto the property ladder, achieving charitable aims, or just saving for retirement, the reality is that people usually have a combination of goals and don't really tend to fit neatly into one box. And that's why it's paramount to really get to know our clients, to understand their goals and aspirations, and also regularly meet with them and check in to see if anything's changed or if they've got any new goals, or if that's still appropriate. And it definitely wouldn't be unusual for a client to join us in the saving phase, and then we'd need to review and potentially change their investment solution as they enter the spending phase. So if we could move to the next slide, please. So in order to provide a solution that's right for a client, our starting point every time is always acknowledging that every client's different. And one of the most enjoyable things about my job is really getting to meet a diverse and interesting range of people and really getting to know them in order to help them achieve their financial goals. And whilst in the last year, it's meant that I haven't been able to see many of my clients face to face, and thankfully technology such as Zoom, and we use Microsoft Teams as well, it's allowed us to still meet and discuss their circumstances and investments regularly, which has been great. So in order to provide the best possible financial outcomes to our clients, we really need to have a deep understanding. We need to know their backgrounds, so we need to get to know about their lives, what their job is or their previous job, their experience with investments, among other things. We also need to understand their investment goals, so what it is actually that they're looking to achieve with this investment. We need to understand their financial circumstances, so we need to look at income and expenditure, if they've got other investments or assets elsewhere. And then finally, also their attitude to risk, and this is a really important one to consider. So Elizabeth touched on risk earlier, and when we think about people, they have what we call an ability to take on risk and a willingness to take on risk. And it's not always the case that the ability and the willingness will perfectly match up. They're not always the same. So when thinking about ability to take on risk, we often look to hard facts. such as how long they're looking to invest for, how much they're going to be investing, how much flexibility do they have? Are they going to be really reliant on this investment? Do they have other investments elsewhere, or is this the only one? And do they have other streams of income as well that can support them? And all of this, along with other facts about their financial circumstances, will help to paint a partial picture and let us get an idea for their ability to take on risk. However, whilst that's quite static in nature, and people are really quite complex, and things aren't as always simple as that. So as such, we have to also consider the human element in order to get a full and complete picture. And so we really need to get to know how people actually feel about risk and their innate attitudes towards it as well. So if we could switch on to the next slide. Thank you. So on this slide, I thought it'd be great to get you all thinking about risk. So here we've got a question, and this is an example of one of many questions we might ask to get a sense of a client's attitude towards risk and really try and dig out what that innate feeling towards it is. So I'm going to give you all a hypothetical example that we'll do a poll on in a bit. But the hypothetical example, so you've got £10,000 and you're looking to purchase a car. Now, at some point over the next few years, you'll be making that purchase. Now, on this question, we've got 5 investment solutions. Hopefully you can see them clearly. And this is how they've performed over a 5-year period. But there's no guarantee that you invested at the start of this journey. So depending on at which point you had invested, this will determine the maximum potential gain or the maximum potential loss. So just looking at the blue line, which has the steepest falls and rises, you may well have invested at the bottom at around year 1. And at this point, you could have seen a maximum gain of 29%. However, equally, you could have invested just after year 3. And if you'd have sold after that, after the sharp drop, you would have seen a maximum loss of 16%. So all 5 of these portfolios have different journeys. At the other end of the spectrum, you've got the pink line, or portfolio E. This has much smaller muted rises and falls. This would have a maximum gain of 5.5% or a maximum loss of 3%. So really, the key thing here is there's no right or wrong answers. It's really getting to you thinking about, in this example, you're trying to purchase a car in a couple of years' time. What portfolio would you be most comfortable with? So if we can open the poll up, we'll see what your answers are. Interesting. Okay, so the majority, 38.4%, went for the maximum gain of 29% or the maximum loss of 16%. So the riskiest portfolio. So really interesting there. Now it's interesting in the sense that you really have to think about time horizon in particular. So say you're buying this car in 2 years' time and you did suffer that 16% loss. That might mean that you're no longer able to afford the car, and so you'd have to delay the purchase. And so perhaps actually a lower risk portfolio would be better suited in that situation. Alternatively, if you did need a higher return in order to afford that Tesla of your dreams, then maybe a higher risk option would be more suited, accepting the fact that you might have to push out your time horizon to buy it in, say, 5 years instead. So lots of different factors to consider. And these are the type of conversations we often have with clients about their goals and their time horizons and what they're looking to achieve. So hopefully that was a good one to get you thinking. So with that, actually, I'm going to hand over now to Matthew Grange, who's going to give you a bit of an insight into what the day job actually looks like. Over to you, Matthew.
Hi, Jordan. Thank you very much for that. I'm actually wondering if the answer to that was because such a high level of risk being chosen there is because you said that the money had been given to people. Yeah. If it had been hard earned, people might not be prepared to take such a high level of risk. I hope you have found those 2 presentations interesting. As Jordan said, I'm now going to try and sort of link those together with what we actually do on a day-to-day basis. I've actually been managing money, just to give you an idea about careers as well, just to link that all in. I've actually been managing money for 23 years now. And I've really enjoyed the variety of the role that you've got. So as a portfolio manager, you'll be analysing companies. So 1 minute you could be analysing a technology company like Amazon or something, for example. And then the next you might be looking at a wind turbine manufacturer, for example. So I can't think of many roles where you can look at so many different industries. And then we invest globally, most portfolio managers will, which means also you'll get very good, strong knowledge of global economics and politics. And it's amazing type of things that you can get involved in. It's very good. Also, I sort of mentioned how long I've been investing money for, because also there is, depending on what side of our industry you join, if you did want a position, is you can take on quite a lot of responsibility at a very early stage. So, for example, if you're looking after private clients, there's a lot of protection there. However, if you're managing money for large companies, like I used to, for example, I was the youngest fund manager in the country at the age of 24, managing £185 million for one company. There's probably not, you've done all the exams, the degrees and all this sort of stuff, but there's probably not many industries where you can have such a high level of responsibility at an early age. It doesn't always happen like that, but there is the potential for that, which I find quite interesting. So what do we do on a day-to-day basis? I mean, if you really think about the end of our day, the markets are closing, you go to bed at night, but in the evening when we're not working, and now the US equity markets are open and closing, the Asian markets are opening. So these companies that you invested into, markets that you invested into, are open and active now whilst you're in bed. Also, there'll be company announcements going on, particularly in the US, for example. So when you wake up in the morning, it's quite an early start in this industry. I mean, I've put a time up of 7 o'clock there. There's many in the industry that are expected to be in by 6 o'clock, for example. So for the portfolio manager, the first thing you'll be doing when you get up is actually reading the overnight news. How have your US companies been doing? Have they announced any strategic changes? And then when you're coming into about 7:30 in the morning to 8 o'clock, you've now got all the UK and European companies announcing as well. So it's a very busy start in the morning, and I really find it quite interesting to see what the news flow is coming through. And that's why we have our morning meetings at 8:30. By then, most people manage to digest the most important things. So Elizabeth and Jordan and myself and a team of about 20 will get together every morning, currently virtually, and discuss all the best ideas that we've got. And because we're global in the way that we work, and so we've got US colleagues in the US. So if yesterday evening they've met with the CEO of Amazon, for example, they'll be relaying information to us in that meeting. So it's a really quick dissemination of information and very, very varied, which we all find quite interesting. Obviously, when we move on from the investment side of the news on investment, we're then dealing with client requests. So that might be money in and out, and dealing with like changes that they might have going on in their lives. And the best way to explain that is one of the things that I've enjoyed, which Jordan actually touched on, is looking after money for a wide range of people. And in particular, I like looking after money and investments for a complete family. So you might have the young adults who are just starting out in their careers. You might have their parents who are building up assets and planning for retirement. And there might be the grandparents that need some extra help, some lower risk investments because they're really going to be relying on their assets. Maybe they're moving into a care home, which is very expensive. So you're looking within one family, you're looking after the whole range of objectives and levels of risk that they can take. So there's nearly no two portfolios that are the same, to be honest, and same with the clients. So to give you an idea of what we've been going through recently over the last years, you can imagine there's been a lot of changes. And it's one family that I'm thinking of at the moment. You've got the young adult, the guy in mid-20s. He's got a long-term investment time horizon. He can afford to take a high level of risk. If we, however, he's in a band, and he normally performs at 20 to 30 festivals a year, including Glastonbury. And you can imagine what's happened to his income over the last year. So he's gone from being able to invest at a high level of risk because he's earning income and he's saving, to now that's no longer really appropriate. He's now needs to rely on his previous investments. So if I actually just scan you, if you could move on to page 18, please. Because I think we've got enough time to cover this. So for us, a medium high level of risk. So this client has taken on quite a decent level of risk previously, which for us is around 75% in equities. Equities are going to be really quite volatile depending on what, like what Elizabeth had been going through earlier, what the outlook is for the economy. And every individual company has its own particular challenges. Conversely, you can get a very high level of growth from those. So this was a very appropriate portfolio. And if we actually scan through to the 2 slides along, so I think if we go to slide 20, please, thank you. I think you can zoom in on your screens of things. I mean, there's lots of companies there that you'll recognise. So the scenario we had during the summer was you take a call from that client. He's no longer able to afford to take a high level of risk. He now needs to start taking money out each month. So what we would do is within this portfolio, we'd start reducing the amount of money that he's got exposed to these companies. And then we'd put them into lower risk areas. And these lower risk areas we'll touch on in the next couple of sessions. But essentially, this client's circumstances has changed quite rapidly. So we're not going to be putting as much money into higher risk companies, whereas we might allocate more money to, we don't actually do it, but supermarkets traditionally are quite a low risk area, or pharmaceuticals is probably the best example at the moment. So if you've been making those quite rapid changes that a year or so ago you wouldn't have imagined that you've been doing for this client. Then to show the range, you've then got his father who's retired, early retirement on a final salary pension scheme, which means he's been given a set amount every month by the company that he worked for over his career. And you speak to him now and he can take a higher level of risk because he's not going on his cruises anymore. People are stuck at home, struggling to spend money, it's actually accumulating wealth. So it's quite a wide range and it's quite enjoyable what you can, how you can help a family. So I don't think, I'm very biased because I've been doing 20 odd years. I can't think of many careers where you can have sort of technical investment areas all around the world, really strong, good general knowledge. And then also being able to help individuals as well, which we really enjoy doing. And the 3 of us also manage money for charities as well. Less frequently, you'll have things like, obviously you're investing into companies, so you might go and visit those companies. Honestly, most of the meetings are obviously face-to-face in a meeting room, but from time to time, you'll actually go and get to do site visits. So, and these are things that the man on the street isn't normally able to do. So I've been to nuclear plants, I've been to a pizza factory, I've been to the Rolls-Royce systems testing their engines, for example, and they are fascinating days out. We also need to, there's a sort of a business element to what we do as well. So we also need to grow the business. So quite often you might be traveling to either look at the companies that you're investing into, or you might be traveling to attract investors to invest with you, or just meeting with investors that with you. So that's why I head up the international side of that. Hopefully you've been sending through some questions. What we're going to do, obviously, in the next couple of sessions, we'll be covering sort of building on what we've been doing today. So I'll hand back to Gordon now and see if there's any questions.
Okay, yeah, thanks, Matthew. That was brilliant. And Lizzie and Jordan. There's been some really good questions, actually, a lot of questions. I'm going to pick this one I like particularly from Ellie, who said, I didn't do maths or economics at A-level, and I'm planning to do law as for undergrad. Can I still become involved in investment banking, and how can I minimize my disadvantage? Thank you.
Yeah, that isn't a problem at all. I think the way the industry's moved over the last few years, actually looking for more diversity of backgrounds. For others in the room that are listening as well, your life is easier if you do sort of economics and finance, because obviously there are professional qualifications that you need to pass, but it's certainly not the case. I mean, our head of investments, her degree is in chemistry or something, on the medical side. I think the way to make life easier for you is if you're thinking of going off to university, there's actually quite a wide range of modules that are available to you there. That it might be worth just that you could pick up you could do an economics module, I'm sure. And that might be a good way of finding out whether you actually really would enjoy it anyway.
Okay, cool.
I'd just like to add as well, all the qualifications I need for my role, I've done on the job. So, I did an economics degree, but that didn't enable me to do this job. All the qualifications I've taken have been whilst I've been working. So, yeah, doing a law degree wouldn't put you at any disadvantage.
Yeah, I just echo that and really say that a passion for investing and companies and everything that's going on in the world and how it all ties together is so much more important than the degree you're doing, and showing that passion and being able to evidence it is fundamental, really.
Cool. Okay, here's an interesting question, which you may or may not want to answer. How does a company like yours profit from all this? Do the clients pay you for your help, or do you get a share of their investments? That's from Trinity.
Right, okay. The tradition in the industry is to charge a percentage of the value of the assets. So the idea is that you're aligned to each other's interests. So the more we manage to get your portfolio to grow, the more that we'll be paid. The idea is that's the sort of on the sort of margin there.
Okay. All right. Another question here from Ben. What's the minimum level, or is there a minimum level of assets to become a client at AS Capital?
Yes, there is. There's lots of different ways. With this session we've set up is actually a conversion of a day-long one that we do, where we could touch on the different ways of investing into the market. So Jordan actually touched on what's going on in the US at the moment, where you've got a lot of retail investors that are using sort of platforms to invest, which is pretty high risk because you're making your own decisions there. But yeah, so this for what we do, it's sort of for high net worth individuals.
Okay. Cool. All right. Let's see. Okay, here's an interesting one. What are your thoughts on the crypto market? Is there an opportunity to invest there and minimize risk?
Definitely disagree with the last part about minimizing risk. As a company, we're not investing into cryptocurrency. We've done a lot of analysis on it, and we still don't see the sort of the fundamentals for it. I mean, if you're talking about sort of precious metals and things like that, you can see the usages for it. But with cryptocurrency, we think the actual long-term usage of it is quite minimal, and it's basically more for speculation than anything else. Okay.
Let's look at okay, so a question from Leon here. So whereas hedge funds are currently being taken over by quants and softwares, how long will discretionary investment firms last with tech advancements, or will the connection with clients allow these jobs to stay around for long?
Yeah, that's a fantastic question. Very good. Yeah, so there's a whole wide range. I mean, that's an absolutely perfect question. The way the industry is moving as well towards quants and things, for example. But I think that trend might be reversing really quite quickly. And the reason why is our next session we're going on about is investing responsibly. It's a struggle to see how a quant fund can do that. We're quite happy with as a group. We've got expertise in all these different areas that's been sort of referred to. But I do think once you've had a session next month, I think you'll see that it's not something that could be replicated. So I think that question was absolutely spot on about 4 years ago. I think now the trend, if you see the fund flows and the requests that we're getting from clients now for investing responsibly, and pushing companies to make positive change, it'd be quite difficult to do that for quant fund.
Right.
And I would just add, from a client portfolio manager perspective, it's those relationships that you have with your clients that are long lasting, and you really have to get to know those clients and become trusted by them. And I think when you think about last year, when we, the height of coronavirus, when real fear took over in markets, and you saw investment markets down north of 30%, it's at that point where you can really show your value, because you're there to speak to your clients, to explain what's going on, to explain what's going on in their portfolios, and it's that human element that I think actually will stand us in good stead going forward, and hopefully won't be replaced by robots. But you never know.
Cool. Okay, a question here from Matilda. I think we'll take one more after this. What are your thoughts on the current GameStop Wall Street situation? Is it sustainable for the people investing en masse?
Well, I'll let the others cover after me, but I mean, a lot of the companies being mentioned are almost worthless. So professional investors, they do not always get it right, but a lot of professional investors thought they were almost worthless. So this is where you'll see a lot of statements coming out from the regulators soon about this, because retail investors are being encouraged, almost like a Ponzi scheme to some extent. The only people that make money out of this are the people that invested early. And if you look at the most up-to-date graphs, anyone who bought last week has lost an absolute fortune. So our role, and actually going back to sort of what Jordan was saying about relationships and about the quant funds, is to help individuals to almost save themselves from themselves. So we had a very large client early last year that when the markets wobbled, wanted to sell everything, and they wouldn't have had the recovery back up from that. And we're also there to try and help people to sort of take the appropriate level of risk. So a lot of people that have invested in the last few days into those type of companies would have probably lost most of what they've invested so far. And there'll be a lucky few at the beginning who'd made money. It's high risk.
Brilliant. Okay, so a bit more pertinent to our audience. Any recommendations for aspiring investment managers, particularly in finding a job?
I'll start if you don't mind. So I'd say just get reading. Read the financial news, read everything you can. There's a really good website called Investopedia, which will provide you good summaries of what's going on. Watch YouTube videos, maybe even start a paper portfolio. You don't have to invest yourself, but you could say I invested in an Apple share yesterday. You can track it and follow it and see what it would be worth in a month's time, and build out from there, and really just get engaged with the market. And I think that passion, that enthusiasm that you show will only grow, and it will serve to benefit your career if you want to enter this industry.
Yeah. Then I'd add to that. So that's really good when you're in the interview. And so the people I've been helping from universities for the last few years, what we have found is that it's a very competitive market to get a job. And my first role, to give you an example, my first role was based down in Surrey. So it's quite rare, but it's a fund management business outside of London. And I was there for 6 years. In 6 years, we received 1 CV. So any of the large houses will receive thousands just constantly. So great if you fill in those application forms and you make it for Goldman Sachs, and I think that's great. But I try and think out of the box a little bit. Sort of investing to local firms, looking for smaller places, which would be one way of going in. Then also think about yourself. Is there anything different about you? So I helped somebody who was from the Middle East at a university. He had appropriate languages. I noticed in the Financial Times, like Jordan said, that a fund was being launched by a big, large asset management firm. I said, look, you've got everything they need for that region. He sort of made contact and he joined them. So do the reading around the industry, and maybe just try and think, not just applying to the top 20 places. Okay.
Cool. Okay, another question here. What is Aberdeen Standard's basic model for estimating the value of a company?
Right, so we're very bottom up. So it's very fundamentally driven. So it's literally every metric you can possibly think of. Particularly on our side, on the private client side, we're very much thinking about the long term. So we're talking about strong balance sheets, good cash flow, and we're very much sort of thematic based. So we're trying to think about, we know what the world is like now, but what are going to be the key big drivers in industries for the next 5, 10 years? So we've actually got a panel of 20 to 30 economists and strategists who really think about the next literally 50 years. And those are sort of the long-term trends that we're trying to pick up, rather than the other approach, which might be, how do I make the best return over the next 3 months, where you're less worried about valuations. So you can just go with momentum on that. So
Okay, another question from the attendees. What areas of the investment markets did well sort of last year, through the COVID crisis?
I'll let one of the others take that.
Yeah, it's all over the news, but technology did fantastic over the last year. If you think Microsoft, there's loads of people working from home, office was needed at home, thousands of people. Amazon as well, another example, people buying things online, we couldn't get them into shops, e-commerce. The tech stocks did amazing, and the valuations at the moment are very high. But they're some of the best companies in the market at the moment.
Yeah, and just building on what Matthew was saying about looking thematically at our investments, some themes were really accelerated during the crisis. So a lot of the stay-at-home behaviours, we typically like, pharmaceutical areas. We actually like the video game area, as we see that as a really attractive growing business. And a lot of that was accelerated through COVID. More people staying at home playing games and in-game purchases, etc. So that was an area we liked as well. But yeah, a lot of acceleration in the likes of tech as well, stay-at-home stocks, people ordering online, like Elizabeth said, in Amazon. So yeah.
Okay. Cool. Okay, so here's a question, a slightly longer question. What is the advantage in investing with companies like yours? There are many ETFs with different levels of gains, risk, etc., with mostly lower fees from what I've seen. Also, with 50% of the market being retail right now, how will the future look?
Right, yeah, I'll pick that one up. So just give you an example. If you're invested into an ETF, they have got their place. We have used them as well, just to say that. But if you've got to look at the composition of the index. So, for example, if you're looking at an ETF in UK equities, for example, the UK has a large exposure to oil and to banks, and there's a number of industries like that. So if you're actually about to walk into a recession globally, the last thing you want to be doing is be passively invested into one of those type of funds. So what you're paying for us to do is to realign the portfolios, like we've been talking about earlier. So it's active management is what we can do for you. And then also we'll go back to what we're going to be covering in the next session about investing responsibly as well, which won't get covered within that. There's always a place for ETFs and innovation, and we're involved in those as well. But we're not here to plug ourselves, but I think we'd be quite happy to show you our performance numbers.
Okay, and actually very, very pertinent on that point. Final question of the session, because there's been a lot of questions. Which of your competitors do you admire the most and why?
Yeah, good question.
Don't have to answer it.
No, it's absolutely fine. Because it's the way we like to manage money is investing directly.
Right.
In companies, which might not sound obvious. So we're picking the companies. So the competitors that do the same, we admire. It's where we do sort of question is a lot of fund managers actually just invest into other fund managers, which you call sort of multi-manager approach. And then if you're comparing to ETFs, then you're talking about very expensive. So you'll have the discretionary manager like ourselves charging a fee, and then putting the money into somebody else's fund for the US, somebody else's fund for the Japan. There's lots of under fees there. So I think anyone who's doing a similar sort of approach to us, we admire.
Brilliant. Okay, I think we'll wrap it up there. Everyone wants to go get a bit of grub, have a drink. But I'd like to say thank you, Matthew. Thank you, Elizabeth. Thank you, Jordan. Brilliant. I hope that was really interesting for everybody out there. We've had a really good level of attendees, which is fantastic. The next webinar is a month's time, so it's March the 3rd. Same time, same place, same backdrop, probably. And then there's the third and final one on the 10th of March, and we look forward to seeing you all then. So thanks so much for coming, everybody, and have a good evening.
Lovely.
Thanks, everyone. Bye.
Bye-bye.
Bye.